Thank you everyone for joining today's webinar, jointly hosted by Chapter 1 Advisors and NWR Communications. I'm David Tasker and I'll be hosting the webinar today. Today's webinar will showcase 4 ASX-listed small-cap industrial stocks. Now, when you think of an industrial stock, you tend to think of ASX majors like Wesfarmers or Monadelphous. And while they are massive companies now, remember, they came from humble beginnings and started with a plan. While we cannot guarantee the companies we've found showcased today will reach the heights of those major industrial stocks, what we do know is they are solid businesses with quality teams and clear growth ambitions. So certainly stocks to watch. While you may have tuned in to watch 1 or 2 of the companies presenting, I recommend you watch all of the presentations. It is the companies you don't know that could be the ones you invest in the future. Add them to your watch list to see how they perform over the coming months. And don't forget, as you're listening to the presentations, if you have questions, submit them using the Q&A function on the screen, and we will put them to the presenters for you at the end of their formal presentation. This is your chance to not only hear from, but engage with the executives of these listed companies. Right, now we're getting into our first presentation, where you'll hear from Babylon Pump and Power Limited, ASX code BPP. Babylon is a specialist services provider to clients in the resources sector. The company operates 3 divisions: rental services for the provision of specialty diesel equipment, diesel maintenance for large Caterpillar and Cummins engines, and industrial services including protective coatings, vacuum loading, abrasive blasting for routine cleaning and shutdown preparation. We welcome Michael Shelby, Executive Chairman. Michael, over to you.
Thanks, David. Let's go ahead and click through a couple of slides here. And one more. There we go. All right. Thanks, David, for the brief introduction. I want to reiterate who Babylon is. We're a small but rapidly growing specialist mining services provider. We specialize in rental, mainly dewatering and power generation, and especially industrial services, high pressure pumps, vacuum trucks, blasting, cleaning, protective coats. And then both of those areas are all underpinned by our diesel maintenance services that we use to maintain our assets as well as client assets as well. Next slide. This is just a corporate snapshot. All this information is publicly available. So I'd like to go next slide and get into the meat of it. One of the key areas I wanted to discuss today was the improvements we've made over the past 6 to 9 months in our team. We're very proud of where the company is and where we're going. The company is a small company. We've been reactionary the past couple of years from foundation, but we've moved into a medium-sized operator. And with that, we've really needed to rejigger our team and our board as well to make sure we have the skills and the ability to grow the company to the next step. With that, we've brought on board a few key executives, Mr. Craig Batterham, Mr. Laurie Phillips. They specialize in the operations, the planning, and the systems required for us to take the next step from a reactionary type company to a medium-sized company dealing with the big guys, trying to have operational excellence. So those guys have been on board for the past 6 to 8 months, and they're now starting to take hold of the business and drive it forward themselves. Also, we've made a key appointment with the board. Ms. Louise Bauer has come in. She's joined the team of the other 3 of us, Patrick, Michael, and myself. We were the foundation directors. We're wanted to round out the company with some key independent, non-executive eyes on the board. And also, we also acknowledge that the ideal governance system is to not have myself as executive chairman and MD, and that's something we're looking to clean up in the upcoming months as we look to place an independent chairman in the month coming ahead. Next slide. You know, we're a small company, but we deal with the big guys, traditionally BHP and FMG have been our largest clients, and spreading out our commodity base and who we're dealing with. So recent wins with Alcoa, and also we've had some recurring works with Pilgrim Minerals to bring in some lithium work there. We're really making an effort to spread our commodity base to not so much shun the big guys, but just add on to the recurring iron ore business that we've been doing. Next slide. Sometimes I feel like I need to reiterate where we came from. Babylon was only founded in February of 2017. We listed on the ASX in January of 2018, and that first financial year did a whopping 1.6 million in revenue. From that, we've grown organically. We've joined on board, and this past financial year we ended up with just over 20 million in revenue. Early days, we had some nice, smooth steps forward with positive EBITDA. This past year, we took a kind of a step sideways in the EBITDA and had a negative EBITDA reported for the year, and that was due to the decisions we made to improve the diesel maintenance business. But we feel like with the team in place and the business processes in place, we're in a good position going forward from here. Next slide. Financial 21 performance, revenue from operations up 24% to 21 million. This is again a good starting point. We have ambitious goals for our next key milestones to get from over 20 to 50 to 100 and thereon. That's the idea, is we need to make some big chunks, but we're happy with where we are for now. Over the past financial year, we had a negative operational cash flow, but in the fourth quarter of FY21 and the first quarter of FY22, we reported positive operational cash flow. Key in this area as well is increasing our assets. The amount of assets that we have increased tremendously with the acquisition of rental assets and industrial services assets. These assets are key for company profitability going forward. Those are the most profitable areas of our business, is the assets, putting those to work, the rental and the service work that goes with them. EBITDA across the businesses are improving in FY22. Ozblast, which I'll give a bit of a background to later on, they were a slight negative contributor for the financial year. They were only on board for about 4 months, but year to date, FY22, positive EBITDA, and we feel like that there's a tremendous upside for that company. Babylon Operations, the legacy company headquartered in Perth, again, provided a strong contribution of 1.5 million of EBITDA. Prime Power Queensland, which specializes in the diesel maintenance side of the business, they struggled a bit last year, but we have a plan in place that we're beginning to execute to both address the top line and the bottom line, meaning we're bringing a different type of revenue in the top, and also we're starting to centralize some services and remove some redundancy that we have by operating both in Queensland and in WA. And we're making strides going in the right direction. We still have a ways to go, but we feel like, again, with the team and the plan, we're going in the right direction. Next slide. Highlights driving growth forward. Again, the top two boxes relate to assets. It's increasing our fleet of assets for the rental business and the industrial services. Those will boost our profits, and those are key areas that we made some investment this past financial year. We have a tremendous amount of equipment mobilizing the past few months and going forward, and then also quoting and new proposals that are going out for the industrial services business. We feel like that will drive the business going forward. Also, last year, we invested in core engines for diesel maintenance service exchange programs. And for our clients, having equipment maintenance, or whether it be a failure, that's very expensive for those guys. So what we've done is invest in core engines that we have built ready to go. It consumes some cash and makes us have inventory in our books, but that's already proved to be very beneficial for us to have some quick wins, to have engines out, relieving the clients of their time of stress for downtime. And then also it builds for more recurring type revenue, and the fact that we're not just reacting and rebuilding a client engine. We have an engine ready to go. We can, or a component ready to go. We can give it as a service exchange to the client, and then we get their engine or their component back to rebuild as well. So it's kind of a 2-for-1 type scenario. You know, in the past, we haven't had the luxury of doing that, but as we've invested in some of the core engines this past year, this is what's we're in. We feel like we're fortunate going forward to be able to take that next step forward. Next slide, please. Next. Growth outlook for specialty rental. We're going to continue to invest in assets. Right now, with the state of the market, with logistics and COVID shutdowns and lead times on equipment, we feel like we're in a good position because we own assets and we have assets out working. We will continue to invest in the specialized assets there to drive forward and get the big, unique, higher dollar type asset. We've had a small win with Nickel West in the water management area, something unique, something different with an evaporator solution for water management. It's a small project, execute well. We feel like it'll lead to larger opportunities. Next slide. Can we go to the next slide? Diesel equipment maintenance. High levels of inquiry and investment in our core engines, our service exchange engines. We've won some multi-year contracts that we've announced over the past month and a half. Go ahead and go to the next slide and I'll jump to that so we don't run short of time. Next slide. There we go. So recent contract win. By having investment in our diesel maintenance core engines, we've been able to win the likes of this work with Alcoa and Premier Coal. We have recurring work with Rio that we've been able to formalize as well. So these 3 contracts are key in that they're multi-year contracts and have significant workforce that we can actually plan. And we have visibility with the clients now, rather than just being reactionary. We're able to properly plan and invest in taking care of their assets going forward, which will improve our margins and just strengthens the relationships we have with these clients. This is part of the upgrade from us being a reactionary company to a medium-sized operating company. Next slide. Specialty industrial services. I'll quickly go through this. Ozblast, a company that we acquired that have significant processes, procedures, people, and assets on the books. Key for this was taking this company and getting it back kicked off going forward. We've been able to have some wins in FY22 with some assets out doing some small project work. Right now we have significant proposals and tenders outstanding for long-term works along the likes of what we've done in the diesel maintenance side of the business, you know, the 2 to 3 year type contracts. And we feel like it's just a matter of time before we're successful with that because of the fact that we have the assets and we have the quality assets available where others may not. Next slide. Strategy moving forward, ongoing organic growth. We want to expand our rental industrial services into the Queensland market where we only do, or we've only traditionally done the diesel maintenance. Because of COVID, there's been some issues and some delays doing that, but we feel like that's going to drive the profitability over there. The next arrow, same thing, assets. Us owning our assets, being able to utilize those on rental or specialty industrial services will drive our profitability, but also securing the material engine rebuild programs as we had gives us visibility, gives us improved profitability, and locks away capacity for our workshops. And as always, we're looking for other opportunities to bring other tools into our toolbox. Next slide. I won't talk much here because I know we're off short on time, but generally the growth drivers have not changed. Demand for our services, demand for our equipment is still there. And there's actually more issues now with clients with COVID restrictions and with supply chain slowdowns across the world. clients can't just go buy new gear. They need our services to rebuild it, or they need to rent our equipment as well. So we feel like that while the world is in pain, having the service capability and the rental capability to continue to grow the business. One more slide. And I'll wrap up with this one. Investment highlights. We recently strengthened our team. We have experienced operational and management forward to grow with the company. We've had some new contract wins that have been announced over the past month and a half. That kind of goes along with record inquiry levels. We feel like that there's a lot more work going to come down our throat in the months and year to come. And we've invested in assets to support that growth. We deal with the big guys. We feel like we're doing a good job, and that's reinforced with the long-term contracts we have in place. But we're also trying to diversify into bauxite, into lithium, into gold, and not only be in the iron ore market. And again, we feel like we're uniquely positioned because it's tough to get hands on assets, new assets right now. So being able to have them, to rent them, and then also maintain client assets is where we want to be. And that should be it. Next slide will be the end.
Great presentation, Michael. I should have warned everyone that Michael did have a couple of minor internet issues, so we did turn his camera off just to make the sound a little bit better. But Michael, we do have a question. Time for one quick question. M&A, you seem to be very good at bedding down businesses when you find something that makes sense to add on. Do you keep an eye out for M&A opportunities, and do they exist in this busy world?
There's always opportunities. We have trusted advisors across the country that bring opportunities to us. But the best way for us is who we deal with, and the people that we deal with, that we have respect for. And generally, we've been successful because it's been like-minded other small companies that we're not taking too big of a bite, but we have some owner-operators looking to transition or looking to get more resources in their back pocket to go attack the market. That's where the strongest leads come from. But yes, we're always interested and always on the lookout. But as much as corporate advisors will sit around and whether it be in Melbourne, Perth, Sydney, the best is on site. Who do you see doing a good job? Who do you want to talk to? Who do you want to deal with? And that's kind of how we've taken our approach.
Great. Thanks for that presentation, Michael. As you said through your presentation, a strong foundation built, the team in place, the assets in place. Now it's all about growth. So well done, and we look forward to following your progress.
Thank you, David.
Our next presentation will come from Pental, ASX code PTEL. Pental delivers a range of branded products such as Whiteking, Country Life, Velvet, Softly, Martha's, Sunlight, Huggy, Jiffy, and others, all of which have been an important part of the Australian and New Zealand families for generations. The company's goal is to help families live better by providing high-quality products for today's lifestyle. Presenting is CEO Charlie McLeish, and I believe you've got a colleague with you as well, Charlie. But over to you guys.
Thank you, Dave. I'd like to introduce Neil Godera. Neil's our Chief Financial Officer. So Neil will be sharing the presentation with me this afternoon. Next slide, please. So Pental's origins began back in 1956 as a humble bar soap manufacturer. And over the years, the company has, through acquisitions, purchased a lot of the regional brands that were once owned by multinationals and formed a full portfolio of FMCG, well-known, established and loved products. Our manufacturing operation is in country Victoria, based in Shepparton. But we also have a major distribution operation based in New Zealand, with 70% of our business being local and 20-odd% in New Zealand, and the rest spread around the Pacific region. Next slide, please, and I'll pass on to Neil to give some highlights on the financials.
Thanks, Charlie. I'll just share some highlights from a market update that we issued literally few hours ago, which I encourage you to log on to ASX and read. So one of the highlights we have issued is that the first half of this year, we're expecting our profit to be about 53% up at roughly about $6.5 million in EBIT, and a good chunk of that it can be credited to our recent acquisition in Hampers with Bite, which we acquired as of 1st of September. So that business has performed quite nicely since the acquisition. And for the full year, we've also issued a guidance of about $9.8 million in EBIT, which is roughly about 20% up on last year's EBIT. Now, just a brief update on the Hampers with Bite acquisition. As I mentioned, the business has been performing quite well at the front end. Sales have been quite significantly up on last year. In the 4 months, in fact, that we've had on the business, the business has outperformed this entire FY21 sales. The integration of the business has been traveling quite smoothly, and we also have a whole lot of synergies on the horizon that we expect to tap into in the second half. So, having acquired the business at the start of the peak season, we didn't want to tinker too much with their plans, and we let it run. So we have some good easy low-hanging fruit there to be picked. Without going into too much detail, Charlie will touch base on most of these points, but more importantly, from a balance sheet perspective, we are a very strong balance sheet business still. So after acquiring the business, we have generated a healthy amount of cash flow, and we're back to about effectively being debt-free. So we have about $12 million in cash with about $4.7 million in acquisition-related debt. So a very healthy business with healthy profitability and a very healthy balance sheet. So over to you, Charlie. Next slide, please.
Okay, why Hampers with Bite? Why did we buy an e-commerce business? We commenced developing both a website and specific products for online shopping some 18 months ago. But what we found is that we never had the expertise in marketing these products online. So we started our search some 12 months ago, and we came across this family business. The family business, well run, good experienced people who had been in this sales channel since 2004. So with the freed up capital from the Duracell business, when Duracell restructured and decided to take the business back and run it themselves in the domestic market, we freed up around $12 million in capital. We raised some, so we purchased this hamper business, which really complemented our own range of products. And as you can see, the sales growth in the previous year with the e-commerce was 65%, with revenue around 25.7 mil. So it's a very solid business. Next slide, please. So the traditional business is approximately down 6% on the previous year for a range of reasons, whether it be supply chain reasons, whether it be through the rise of raw materials. But we expect this to be offset by strong performance in New Zealand. But also, more importantly, we take the outlook for H2. We have implemented a price recovery and reformulation and the supply into Bunnings. We are supplying Bunnings with our Whiteking range, which we believe will offset the deficit in H1. Next slide, please. So just give you an idea on where we're at today and where we are taking the business into the e-commerce. We developed a range of products using our core products. The first to market bundle packs. Here's our Velvet range. Next slide, please. Our Whiteking. So you'll find the Whiteking range is now being developed into home household cleaning packs to be sold online. Next slide, please. A new Velvet Tradies, a new Country Life Tradies pack, which we're launching into the major hardware chains and one or two of the pharmacy chains for H2. Next slide, please. And more importantly, product innovation with sustainability being fresh on on consumers' minds, especially the new educated consumer coming through now. Whiteking, which has traditionally been a powerful bleach branded product, we have now developed first to market 24-hour germ defence surface cleaning products that are being presented to the major supermarket chains as we're speaking now. Next slide, please. Refillables with less plastic, making sure that sustainability is fresh on all our product innovation. Next slide, please. Also, keeping up with again sustainability, making sure we have advantage over our international competitors. We are now launching a whole range of innovative new products where you add water under the Sunlight brand. Next slide, please. So I'll just pass on to you, Neil, to talk about the financial forecast.
Yes, no, thanks, Charlie. Thanks for that. And as I briefly touched base earlier, our first half looks very, very bright. For those who aren't very familiar with the Pental story, just to sort of a little bit of a recap, we were the master distributor of Duracell brand up until last year. So what that meant is that since September 2018 to May 2021, every Duracell battery in Australia market went through us, and as of May 2021, that arrangement sort of came to an end. Not entirely. We still retain about 20% of the business, but 80% of the business Duracell took back, and they decided to run themselves. And that left a sort of a big hole in our profitability as well. And plus, we were already working on this strategy of complementing our brick and mortar footprint in Australia with an e-commerce channel. This is where Hampers with Bite comes into the story. So long story short, the shortfall of the Duracell profitability has been more than fulfilled by the acquisition of Hampers with Bite, and it also has now enabled us to launch a whole lot of our product range that couldn't go into brick and mortar stores for a variety of reasons, and that direct reach to the consumer. So we remain quite positive and optimistic about about our future and the second half, and this financial forecast basically reflects that. So our first half, we will be up about $2.5 million in EBIT, even though we don't have the Duracell business that we did have last year. And for the full year, we are expecting to be about 20% on last year as well. And also, that's also keeping in mind we did face some headwinds in this half, and as every player in our sector would, around commodity pricing going significantly up. So we are tackling that, and we are quite positive about our outlook in the second half and going forward. Thank you. Next slide, please, and I'll hand it over to Charlie just to finish off with our strategy as to where we are heading.
And as I presented earlier, we're focused on sustainability. Our traditional consumers being the over 40 consumer. So to engage the new consumer coming through now, you have to have a very, very strong sustainability strategy in place, which we're building. And sales growth in new channels. Back to the Hampers with Bite story. We are now developing a whole range of products to complement the Hampers with Bite range. Also, with the very, very strong team within Hampers with Bite, we know that they'll take a lot of our traditional products and make a huge success of those within the e-commerce channel. Building customer partnerships. For the first time in the Pental history, we just recently have been ranged in Bunnings hardware stores, and we're now supplying Bunnings with a full range of products. That impact will mainly be in H2. Back to being competitive and innovative, we've touched on that, and new cost down initiatives. Due to the increase in a lot of our commodity products that we use at our manufacturing operation, whether it be tallow and palm and paraffin oil, we now have a lot of projects in place which will give us some cost recovery in H2, as well as being supported by our major customers. So the majority of our major customers have accepted a price increase, which will take place early February to recover what we've experienced to date. So developing new partnerships and again exploring new strategic acquisitions. I think you'll find that because of the hampers with Byte success story and the continuous growth, we have proved that we can do it successfully, and we are now looking for another acquisition. Thank you, David.
Great presentation, guys. Thanks for that. And as you've mentioned, I think for the audience watching and our extended families, most of us know your brands, and they're very trusted and well-liked and well-supported. So congratulations on building out a significant business. A couple of questions. It shows you the level of sophistication of our audience. There's a couple of cracking questions coming through. What kind of levers does Pental now have at its disposal to expand its margins and deliver more sustainable growth?
Again, we're quite fortunate. We have some very good talented chemists within our team, where we have been able to develop, as I showed very quickly through our product innovation, products that will be first to market, products that are not me too products. So with our traditional brands, it's very important that we focus very strongly on being innovative, and to grow the traditional business, you must be innovative and be able to demand a higher margin than focus on being just another me too product. And I think that is one of our key strengths.
Your attention, please. Your attention, please. This is the check board. The annual evacuation exercise for this building is about to take place. Please listen to the tones and follow instructions of your wardens. I repeat, this is your chief warden. The annual evacuation exercise for this building is about to take place. Please
looks like we might need to cut it there, gents. There are a couple of questions, so if you want to look at those online, you can deal with those then. But thanks for a great presentation and good luck with the fire drill. Okay, as we say with webinars, anything could happen and anything does happen. So we did know that there was fire drill being lined up for the guys at Pental, but it came a little bit quicker than expected. Now, next we have Westar Industrial presenting, ASX code WSI, with Managing Director Rob Spadanuda to present. Westar Industrial is an industrial steel fabrication, installation and maintenance services company focused on the resources, oil and gas, water and infrastructure sectors. The company operates two flagship brands, Simpec for high quality construction and engineering services, and All Type Engineering for steel fabrication expertise, site installation, construction and maintenance services. Rob, over to you.
Thanks, David, and thank you for having us. I'm here to present the growth plan for FY22 in this investor presentation. So if we could have a turn of the slide. Just briefly, for those who don't know, Westar Industrial is an industrial services company. We operate in the energy, resources, utility, defence and infrastructure sectors in metro areas and remote areas across Australia. I'll provide an overview today of the company's conglomerate business model, which sees Westar provide a range of industrial, manufacturing and fabrication, installation services, construction services and maintenance services for the main areas being energy, resources, water and infrastructure, through, as you said earlier, the two subsidiaries, Simpec and All Type Engineering. If we go to the revenue growth chart here, we look at, I suppose, the rapid growth that the business has achieved over a short period of time. We set about some years ago to establish a strategic plan, and we now find ourselves moving through that plan. A number of factors, but one of the most important ones was to grow revenue and profitability, and that's what we're about at the moment. We're, I suppose, in a maturity phase. As you can see, FY21, the group revenue was circa 72 million, and our current order book is very strong at 222 million. That's all contracted revenue, all being delivered as we speak at the moment, and moving into the second half of the financial year. We continue to be strong with some delivery also moving forward to FY23, a unique position for the company. Slide, please. So predominantly there's two brands. We've touched on this a little earlier. Simpec is a diversified services company, construction services, asset management services, strength in SMP and E&I, very strong management team, long history of delivering large scale projects run by a very strong MD and a very strong team. All-Type Engineering again was a recent acquisition about a year ago. 30-year history, workshop fabrication, site installation, maintenance services with a very specialised areas such as oil and gas, water and power generation. Two very strong brands in their own right, two very well-known brands in the market, and both companies are delivering some really serious goals at the moment and delivering a very strong performance. If I could change slides, please. So reflecting on FY21, as I said earlier, we had a revenue of circa 72 million, increasing year on year. The contribution was quite even between the two subsidiaries. We delivered an EBITDA of 3.4 million. And I mean, I'm focusing today on profitability. As we enter this maturity phase that we're in at the moment, we come from 2 years of profitability historically, and our expectations are that this year will be even stronger in that area, along with revenue and profitability. Contracts awarded in FY21 was circa 72 million. As you can see from the previous slide, I touched on, we already have contracted $222 million worth of work, and that's a significant jump. It was part of our strategic plan. It is part of the maturity phase of the business. The business to date in the first quarter of FY22 has already delivered cash receipts of 40.9 million at the end of quarter one. Very strong in cash balance of 15 million. As I said, strong order book. And as we've come into, I suppose, the December quarter, our expectations are that is going to increase and increase significantly. And the main reason being is because the workload is there to deliver, and our expectations is that the profitability will flow through at a higher rate. If I could have the next slide, please. So I won't spend too much time, but this slide's interesting. It gives you an indication of the type of client base, all tier one clients. As I said earlier, our reputation is strong. Those two brands, Simpec and All-Type, are contacted for work every day. We are asked to tender on all major projects in our skill set. I touched on some of the projects here that we've worked on over the last few years with Simpec, one of the larger projects for Tianqi, First Quantum Minerals, Talison, FMG, Rio Tinto, these sorts of clients. You have to have a reputation to be working with these clients, particularly in the scopes of works that we're delivering, which is predominantly, as I said, in the construction services space. So, I suppose in that regard, Simpec is kicking a lot of goals. All-Type, as I move on to All-Type, recently we announced the Lynas Rare Earths Rotary Kiln Erection Project, and APA Group, a very good client of ours, repeat work that we've been getting, and that was a significant $25 million contract, along with companies like Rio Tinto and AGIG. If I could have another slide, Tim, please. So in recent times, we've been focusing in on a large project which we were awarded by FMG, and I think at the end of the day, because of the $222 million worth of revenue, it's important to focus on this project we won with FMG. We are into the project now. We are delivering all of the deliverables on time. The project is going well. It's circa $145 million wet process plant, as I said, in the Iron Bridge, Pilbara region. It's the largest contract win to date We strategically set out to put a team together in the early days to win this project. It was our organisational chart, and in particular, the strength in the managing director putting the team together to be able to deliver this project. These projects don't just fall in your lap. You've certainly got to have the experience and the personnel to be able to deliver them. And we were trusted with delivering such a large project. And I think it's a feather in our cap, and in time, Simpec and of course WestStar will reap the rewards of a project of this size. As I said, it's going very well at the moment. As far as labour goes, we've fulfilled all of our requirements. The project has a personnel requirement of circa 500 people. So it's a decent sized project. It's a big project for the company. In summary, it's going well. The leadership team, they're absolute leaders in their fields, and we have absolute confidence that the project will be delivered on time and it'll be delivered profitably. If I could change the slide, please. So we always go into the key risks, being that it's a large portion of revenue for the company. The interesting thing about the project is from a procurement perspective, most of the materials are free issued on the project. So it takes away that risk, and predominantly they're free issued items from the client. We've talked about capability and the personnel that have been handpicked to deliver the project in conjunction with our client. The current workforce is strong. The competitive rates that we've achieved on the project are strong, and recruitment is going very well. Finance and funding, I can touch briefly on. We'll probably come to that at the back end of this presentation, but we've recently announced a strong bonding facility with Export Finance Australia, which has enabled us to take on a project of this size. I'll come back to that shortly. Payments and cash flow, there's absolutely a cash neutral intent on the project. Cash flow is going extremely well. We're being paid very well, and the relationship with the client is very strong. And the program is a circa 13-month program. So, it's a large amount of revenue being delivered in the financial year, the majority of which will be delivered this financial year. And from a contract perspective, it's a lump sum remeasurable contract, bill of quantities and schedule of rates. So we feel we've covered the risks. We feel that we're going very well on the project. We're very excited to deliver the outcome of the project. We feel that once we've delivered a project of this size, it certainly resets the business for the future to take on larger projects still. Slide, please. I'll touch briefly on management, but most importantly, the two strong MDs that run both the businesses. They have significant experience in working with first-tier companies. They have an excellent safety culture and very strong fundamental core values. People are everything in this game. The two managing directors that run very large teams are people first, and I think that can be a throwaway line, but at the end of the day, companies need to consider their people first to be able to deliver on projects of this size. Next slide, please. So I touched earlier on Export Finance. We've recently received a $7.5 million bond facility, which is a feather in our cap. The Export Finance bonds are Australian government backed. They're AAA rated by Standard & Poor's, and what it's enabled us to do is release $5 million instantly to the company's balance sheet, and enables us to take on bigger projects. Also, we recently completed a $3.5 million placement. So that was supported very well by institutional sophisticated investors. We continue to tender strongly. Working capital is available, and contracting activities are going well. And we've extinguished all of our debt. The company has zero debt. So it's a wonderful position to be in. We're very proud of the achievements we've achieved to date. Next slide, please. So finishing up, we've talked about financial performance. Year on year, we're increasing revenue and profitability. We're very well positioned for growth. In delivering these large-scale projects, reputation will continue to improve. We have not remained silent that our expectations are that further awards are pending for the company, and they'll continue to come in. We have the ability through bonding to be able to deliver these these new projects. We've got a growing reputation. We've increased our geographical footprint to work all over the country, and we have a proven leadership team to be able to deliver on that work. Thank you.
Thanks, Rob. Great presentation and a really interesting company. A question for me, and maybe it's you get this question from the market and the market analysts. Given the significant growth in the order book over the last 12 months, do you think there's a bit of fear or a bit of concern in the market, which you've clearly dispelled, that it's going to be hard to actually deliver that order book profitably and on time? And how do you answer that question? I feel you have answered it, but I feel like it just needs to be reiterated.
Oh, look, I suppose we as the company feel very strongly being able to deliver the project. These projects don't fall in your lap overnight. Third-party reviews of your business, your systems, your structures, your finances, and your ability to deliver the projects are what delivers these projects to you. So it's not just a matter of tendering a project, hoping you win the project at a price and you get on and build it. It doesn't really work that way. So in the first step, you have to be someone and you have to be something to be able to receive these. We have set ourselves up for success. We've got strong funding, a strong balance sheet. We've got exceptional people on the project, pre-qualified through the client, the ability to deliver projects on time historically. And I think at the end of the day, I think it will speak for itself. We are absolutely in that maturity phase now of delivering this project. We cannot wait, to deliver this project successfully, because a young company like ours suddenly in the very near future becomes known as a mature company that has the ability to deliver. So I'm hoping that sort of answers your question.
It does. And I suppose a linked question is, many will see the size of the order book and think you've hit capacity, that there's no growth for further big contracts, that what you've got in the book is the book. The bonding, the additional capital that came in, is that setting you up for the next lift?
Absolutely. So, the bonding doesn't stop there. I mean, the government-backed organisation that's looked into our financials has enabled us to be able to get ourselves to the next stage to get more bonding to deliver on more projects. So I suppose from that perspective, we have the resources, we have the cash raised, we've got a strong balance sheet, and we're not at capacity. Every project that you build teams. And I talked about people earlier. Put the right teams together on the projects, deliver the projects. It's not one team that delivers them all at once. They're individual teams. So we can mobilize a new team to a new project. And that's how we roll. That's how we work. You put the right team, the right skill set on delivering that type of project.
Thanks, Rob. A great presentation, and clearly, as you've said, moved through growth into maturity with the next level of growth to come. Exciting times ahead for Westar and its shareholders. Thanks for your time.
Thanks, David.
Last by no means least, we have a cracking company that is doing some amazing things in a part of the market which excites not just those who are in it and their shareholders, but also those who see it for the first time. We have presenting Fertoz Limited, ASX code FTZ, who are aiming to become an integrated global fertilizer marketer and producer, initially supplying the North American and Australian organic and conventional agricultural markets. The company's key focus as a certified organic manufacturer is on providing quality organic input supplies and support for North America's booming organic market. Joining us is Executive Chairman Patrick Avery. Patrick, thanks for your time, and over to you.
Thank you, David, and good afternoon to all of you. I'm actually coming to you from Denver, Colorado, so we're pushing 10 o'clock at night here, so we appreciate the opportunity. I'll go through this quickly, but we think we have a pretty unique value proposition that's actually going to have positive global impacts. So why don't we go ahead and start on the slides. Financially, we're a good solid position, market cap of about $60 million. Stock has finally been steadily increasing this year with our advancing sales and carbon performance or carbon efforts. So we think we have a good solid base and ready to grow. Go ahead. Got a great board and management. I mean, all the presenters just said, it takes a team, and we have a saying, of course, it's kind of in North America everywhere, that a good team can take an average company and make it spectacular. A bad team can take a great asset and run it in the ground. Our board is quite experienced, brought forth many businesses, serial entrepreneurs, and then our key staff. It is kind of funny when you look at the years. We hire very experienced people. Most of them have been in ag or operations or grain for 20 and 30, 40 years. Rianne's our youngster at 10, but very experienced people that know how to operate. Go ahead. We started with a pretty simple proposition, and we've been around 5 or 6 years. We hold a significant number of high quality phosphate leases in North America. And we also bring product from Southeast Asia into Australia, a fused phosphate product. We wanted to really focus on the organic market. Our rock phos and now our nitrogen products are very high quality, very low metals. But it was tough. There is no real supply chain for organic. Conventional fertilizer, synthetic fertilizer, great stuff, feeds the world, but it dominates the supply chain. So we had to go to individual growers, maybe standalone smaller dealers, but we provide organic farm inputs, low carbon base, native based carbon generation. We'll come back to more of this, but we're changing agriculture in North America, and I think we'll keep that process going in Australia also. Go ahead. And we started out with a strong ESG philosophy. I'll be candid, I made conventional fertilizer for about 15 years, and it feeds the world. But candidly, ammonia, urea, aminated phosphates put out a lot of CO2, a lot of salts in the soil, and some runoff. So when the board and we got this vision of high quality rock phos to make organic fertilizer, we really think it was the right thing for agriculture. But then we also found that, because all we do is simply crush and screen our product, it has low carbon footprint, and actually we'll start building out this business of carbon trading and carbon offsets. We've got great partnerships with growing companies. We've looked at this global industry, and we think we can grow in a very safe, low risk manner, and we're always looking for diversity inclusion. Go ahead. So we started simply, start making organic farm inputs. Organic fertilizer has to be certified by a governing board, ProCert in Canada, California, Oregon, Washington, OMRI in North America, certainly Australia, Philippines where we sell. And as I said, it took a while to break into the supply chain and start really growing. But we have really launched off. Some of the concerns again over conventional fertilizer, our orders rocketed this year. We sort of doubled and tripled. We sold more in the last 6 months than really the previous couple of years. We're adding a lot more of our processing facilities. We have 3 to 4 to 5 large leased phosphate resources. We contract crushing, screening, and granulation, but now we're bringing that in-house. And the bottom slide's important. Almost 30% of farm-created greenhouse gases are a result of synthetic fertilizer. Agriculture is a great thing. We all need to eat, but agriculture contributes about 15% of greenhouse gases globally. So we think we can have a great impact on that, very positive. Go ahead. Most people know this, I'll do this quickly, but again, Fertoz targeted the organic market, organic food market. We provide inputs to certified organic growers who then sell to larger certified organic distributors and food companies. One thing about it, food around the world is relatively flat, some growth due to population, but the organic market, particularly in USA, but Australia and Canada, is growing 10 to 12% a year. And we hope we capture a significant piece of that. Next slide. But what's interesting is, as I said, we really started diving into phosphate extraction and growth. But then as this questions about carbon, what happens really as you make synthetic fertilizer? How much can the plant sequester? How much can food sequester? we found out again that through our simple processing, we're essentially carbon neutral when we make a product. And so we've started generating carbon credits, starting to trade carbon credits. So if a grower or a dealer uses our phosphate product, we also have some emerging nitrogen products made out of alfalfa pellets that are carbon negative, that we can actually calculate those carbon credits and provide them a carbon credit and start trading carbon. I'll build that out as we go. Go ahead. So one of our competitive advantages, again, you hear globally, a lot of people are doing carbon trading, which is great. But we actually have the base product that's essentially carbon neutral fertilizers. So we actually have a double value proposition. We can sell organic inputs, zero or no carbon. And then as the crop grows and yield gains, we can add more carbon credits or carbon positive, and then trade those credits with the grower. So we actually have a big whammy here. We produce low carbon fertilizer. We know that fertilizer has significant yield growth. That's kind of the second bullet. We've measured that for years. And then the soil sequesters carbon, the plant as it grows sequestered carbon. And so we're dealing in carbon credits in the ag industry, and actually we're now moving into forestry and reforestation. Next slide. So, some of this just seems, simplistic. You've seen the carbon cycle, CO2 is emitted and plants take it up. But boy, globally, there's just so much more exacting science now, like which crops really sequester carbon better. Is it held in the plant or the soil? How much can we reduce CO2, but also nitrous oxide and NO, nitric oxide. So we're looking at all that whole entire chain of plant growth and carbon sequestration. So we'll generate income by selling high quality inputs that are carbon neutral, and then working with agribusiness growers and dealers to calculate what crop did you put in, how much did it grow, and how many carbon credits that is, and then ultimately sell those credits with some of our partners. But having a base product to sell that makes us fairly unique from just carbon trading. Go ahead. So we're doing some exciting stuff for a small company. As I said, we started out, main focus was organic fertilizer, and still is. But then this carbon market really developed. But we determined we can't do all this ourselves. A couple of just funny things going on, and I'll jump into kind of the third name. Again, to measure soil health, soil carbon, plant growth, harvest yield, that usually takes an agronomist or agrologist walking those fields and that sort of thing. Well, you can't do that globally on every acre. And so now a lot of that work is done by drone or satellite viewing. You can actually tell soil health, nitrogen, phosphate, potash, CO2, and carbon by drone and satellite imaging. Trimble is a huge supplier of resources to the agriculture industry, precision cropping tools. They also do carbon trading. They've been carbon trading for 7 to 8 years. Bright Spot is our verifier. As I said, Data PLP does a lot of our satellite measurements. And then actually the drone picture, which we'll show you more of, we're actually reseeding some agriculture and forestry areas and actually our own mining sites by drone. Seed and fertilizer dropping by drone. I'll come back to that. But Trimble's had great access to growers around the world. And the benefit of, agriculture tends to be 1 year crop, maybe 2 or 3 of its hay. But the other reason we're looking into forestry is we're looking into 5 and 10 and 20 and 25 years of carbon streaming. Go ahead. So what happens? How does this actually happen? I mean, we know people we sell to, and we can encourage them to participate in our carbon programs. But it's much more complicated. You actually have to have protocols, measurements, verification, and credibility. And so there's fundamentally 2 markets in carbon trading: regulatory, where a government agency runs it, Alberta had a program a long time. Saskatchewan is starting a new one. Environment Canada is probably not too far away from a full-blown trading program. US EPA a little farther behind. Australia actually leads the world in a lot of this. Great government programs and great credible measurement programs. So we have no-till conservation cropping. You know, if you farm properly, keep the CO2 in the ground, then you can gain more carbon credits. NERP is actually nitrogen emission reductions. And so we're going just from conventional farming to really, you know, carbon management. The other interesting thing going on is I've said the word organic fertilizer many times. A lot of our sales now are actually blends with synthetic conventional fertilizer, because if they blend with our product, it brings their carbon footprint down, less environmental runoff, and much improved soil health. So we think we can penetrate a vast market with this, agriculture and forestry. Go ahead. And so, you know, I'll just tell you, we, as I said, we actually mined rock this year. We extracted rock out of southeastern British Columbia, and we got done. We actually reseeded it and fertilized it with drone. And it's very efficient. Just visualize, like they'll bring 10 drones out and maybe 5 are flying and spreading material, and 5 are charging their batteries and loading seed and fertilizer. It's an amazingly efficient process. We did a small trial in West Virginia, and we've got a number of reforesting and reseeding projects in the pipeline. I'll wrap up, go ahead. So really the next 12 months is really keep that going. We're going to get our no-till conservation protocol approved. We've got several other protocols showing that our manufacturing is low carbon and that our yield absolutely demonstrates a carbon sequestration. As I said, that's the regulatory market, but the voluntary market is large too, much larger actually. And so you can actually do voluntary trades. People are looking for carbon credits, and we're providing carbon credits. So we think we've got an exciting future. I mean, our growth in just fertilizer is growing very well. Organic fertilizer blends with conventional fertilizer, but all of that's going to generate carbon. And then again, we're in large industrial areas, forestry and mining that we can reforest and work on abandoned mine lands to trade carbon credits. So we think we've got exciting times ahead of us. I'll turn it back to you, David.
Thanks for that great presentation. And I love people who are clearly excited about the company, its projects and plans despite the time. So Patrick, I really appreciate the presentation. Now we do have a number of questions. So if you'd let me shoot those through, then we'll go from there. So selling an organic product into what traditionally is a non-organic industry, what's the pitch and how's the pricing power work?
That's a great question. And the real pitch is organic food carries a good premium. Right now, globally, conventional agriculture, conventional crops, price is fairly good. But probably in the last 5 years, organic premium is about 30% higher. For wheat, peas, beans, corn, organic's about 30% higher as it goes into higher retail, Whole Foods and those kind of thing markets. So that's one value proposition. Again, much reduced impact on the environment. And now with this trading carbon credits, it's a whole stream of value.
And looking at the ESG lens that a lot of companies have to look through now, how important is it to, an eventual end user of your product, and maybe not even in the first or second step, but well down the line, that your product does have those carbon credits and those organic credentials that help them build out their ESG footprint and sort of story, if you like, well down the line. We're seeing it with batteries, we're seeing it with cars, where it's not just the first input, it's all the way down to the raw materials that feed in that give it the ESG, the tick that it needs.
Boy, that's insightful. And again, I'm somewhat more North American based, but companies like General Mills, Whole Foods, they're actually requiring their growers provide their ESG score. They have to demonstrate it's organic or a blend of organic. They have to show that they use these low carbon or no carbon protocols, and that's how they get the premium price. So it really is, and I want to assure you, there's a verification chain the whole way. As I said, our fertilizer is certified, and then all of our carbon measurements have to be certified and verified. That way, the grower can take those to the food supplier and show compliance and get that premium.
And are you seeing certain?
Say quickly, David.
Sorry.
You know, we think the carbon market is growing, and I'm sorry. So if a person plants, say, 1,000 acres of peas, and peas happens to retain about 10 tons per acre, well, the guy's going to generate, 5,000, 10,000 tons of credit. And if those are going for $20, $30, $40 a ton, that's a very attractive revenue stream for a grower.
You're exactly right. And are you seeing certain markets in certain jurisdictions skewing towards your product and your product range purely because of the ESG and the regulatory requirement, particularly around emissions targets?
We are, and that's really has contributed to a lot of our growth. We've had steady sales in Australia, but in North America, yeah. And two things are happening. I want to be candid. Global fertilizer prices, conventional fertilizer, are quite expensive now, and the supply chain disruptions are tough. And so, we're in great agricultural areas, and people know that they can get carbon credits and reduce their carbon footprint. So there's a number of incentives.
So it ticks a lot of boxes, not just from a product point of view, but from an ESG and an emissions target point of view. So some of that, maybe an unintended consequence, but it's certainly a valuable tick in the box for a lot of those groups.
That's a great point. And really, most large farming, certainly large agricultural companies, they're being measured on their ESG score and their carbon footprint.
And there was one question here around access to urea. Are you seeing that as a problem, not just for a business such as yours, but the wider fertilizer market, given the restrictions that China's placing on that commodity?
Very much so. Now, again, we sell an alternative to urea, alfalfa pellets, which are lower concentration, but there's no question. I mean, in a nutshell, ammonia is produced from natural gas, and then ammonia and nitric acid make urea. And frankly, those are expensive and in short supply globally. And so again, the fact that we're in great cropping areas and great agricultural areas, our mines and our plants and our products, we've got a very direct supply chain. But yeah, I think there'll be big disruptions in ammonia, urea, and 1152 phosphate.
And as you say, that has a limited to no impact on you, given you have a product that doesn't rely on those inputs. So again, another opportunity. Last one from me. How quickly can you translate your agronomic studies and preparations for carbon projects into cash flow?
Another spot on question, and it varies. If a jurisdiction has had carbon programs before, like Alberta, Canada, Saskatchewan did a fair amount of work, they can go through your protocols and measurements. But yeah, we've had about 5 years of field trials to show how much growth comes from our organic fertilizer. So they take that yield gain calculation and our processing calculations and what the farmer's doing to calculate that out. So my point is, places that have had protocols and good agriculture programs and measurements are doing quite well. Countries or states that don't have that, it's a slow process. I mean, you really do need field trials, proven farm practices and measurement. Like I said, and that used to be done by agronomists on the field, and now it's being done by satellite and drone.
Well, thanks for that, Patrick. A great presentation and a really interesting company that I urge everyone watching to follow. We may not see it as much in the Australian market, this ESG thematic playing out, but it is rapidly playing out around amongst the investors, small cap funds and institutions, both in Europe and in also North America. So you're clearly positioned well into that thematic, and you've done the hard work in the days before to make sure you're ready for it now. So Patrick, well done to you and the team.
Thanks, David.
Well, everybody, thanks for being part of this Industrials Focus webinar today. Thank you to the Chapter 1 advisors and NWR communications teams for all the work that went into pulling this event together. Thank you also to the company executives for introducing your respective companies to the large investor audience watching via Zoom, YouTube, LinkedIn, and Facebook. I'd like to thank everyone for your attendance. I hope you found some stocks to watch, and all the best.